Hi, this is Mark Wahlstrom,
And this is Jan Schlickman.
and welcome to a special edition of Speaking of Settlements. Jan, this has been quite the week.
This is changing moment by moment, Mark. This AIG situation, I'm telling you,
Yep.
it's making me very nervous. I don't think I'm alone.
Yeah, well, I think everybody is nervous. The thing that's amazing for me as a structured settlement professional, and my fax machine and my email is just churning out PR, press release, and financial statement from life insurance company after life insurance company telling us how well capitalized they are and how stable they are. And the good news, Jan, is this is not just PR fluff. They are well
Yeah.
capitalized. They
I
are
wanna-
stable.
I want to emphasize that point, Mark, because I started out with that, but I've been hearing all sorts of contradictory things in the media,
Yeah.
one way or the other, and hearing it from other colleagues.
Right.
So I want to ask you specifically about that, because there are many out there, myself included, who are very nervous about this. Now, two issues.
Mm-hmm.
Many of us, AIG is a huge insurer, so many of us have AIG products,
Right.
where there are structured settlements that have been, or we may even be negotiating structured settlements in which AIG could be the insurer behind that structured settlement. That's
Right.
one. All right. And many of us also have cases in which AIG is the insurer, the liability insurer, and we're wondering about what it's going to do to that liability insurance policy.
Right, right.
Since in many of these cases, of course, that might be the only asset available. So I want you to
Right.
address both of those. Should be nervous on one or the other, or both, or neither?
Well, I think the good news is, and I'll take the second question first, which is the discussion of the AIG property casualty arms and attorneys who are currently negotiating active cases with AIG. And again, AIG is just they're pervasive. They're everywhere. They have so many subsidiaries. They're in aviation, auto, marine, property casualty, reinsurance, excess surplus lines. You're almost hard pressed to do a case over $1 million and not run into AIG somehow, somewhere. So it's a common concern. A lot of people are worried about it. I think the good news is that I've heard absolutely nothing through my contacts in the insurance community that there's any risk with either the property casualty or the life markets. I mean, the good news is that many of the mistakes that were made in the early to mid 80s, early 90s, where we saw
Is that executive life you're talking about, and all of the
right.
those fast and loose structured settlement companies that came in with
Right.
a big rush there and sold a lot of stuff, especially in the medical malpractice field?
Correct. A lot of those guys, a lot of those excesses were corrected in the life insurance side, but on the property casualty side, companies like Mission Insurance, who a lot of people, old timers, will remember, big, huge reinsurance and property casualty firm that was essentially liquidated. A lot of reforms are put in place, both on the property casualty and on the life insurance side, about how they manage their reserves, what type of assets they can have, how their reinsurance contracts are structured. It is very, very difficult, and to their credit, the state insurance commissioners have set up very stringent guidelines about reserving and protecting assets.
This is one of the things I wanted to ask you about. I was always
Yeah.
under the impression that New York, in particular, set the standard, and then everybody was always, saying, well, the New York has this excellent way of making sure that the assets are protected on these insurance policies. Is that still in place, and is that
Yeah, that's
that's
still the case, and New York really is and has been the gold standard as far as consumer protection and enforcement of life insurance companies, property casualty companies, and protecting consumers and policyholders. But really gave me pause, and I think what really brought out a lot of the rumors this week was the news on Tuesday morning that the New York State Insurance Commissioner and the Governor of New York had approved a conditional loan of $20 billion from AIG subsidiaries to the AIG parent as part of this bailout. To my knowledge, and everyone we've talked to, that loan has not been exercised, did not go through because of the $85 billion bailout.
Is $85 billion loaned by the federal government?
Right, exactly. So the situation that we have, where some people were concerned, that's really not a concern at this point. I think what we really need to stress to trial lawyers and people around the country is that their claims are going to be paid. The companies are well capitalized. Yes, they were the major subsidiaries of AIG were downgraded by Standard & Poor's this week and AM Best. They were moved down to single A or A- status. But that's really more a reflection of the concerns that the rating agencies were addressing. in the big picture, concern about a run or a panic on the company, rather than
the parent is another.
Right,
The
right.
parent's difficulties, which should be, but the parent's difficulties can reflect in that rating.
Right.
But even with all these parent difficulties, it's really just it's still in the A category,
Right,
right? And so,
right.
no, but I just want to ask you again, though, Mark. I want to be very clear on this. Are you saying, based on your experience now, and I'm going to hold you responsible for all those people out there, Mark, so answer carefully here.
Tens of millions of policyholders. Yeah.
Well, right now, if you were working, and I know this hypothetical as it goes to to reality. If you are working with lawyers who are right now in negotiations or considering some product that might involve AIG, your level of comfort right now is that what should they do? I guess maybe is a better way to ask it. Do they have to do something special, or can they just assume that it's business as normal regarding that particular product?
Essentially, the way that I would handle it right now as a professional is that if you have a property casualty case or a claim in which AIG is concerned, I would not panic. I would not try to settle your case in a hurry. I would not try to discount the case to get a settlement in order to get funds. The property casualty companies are solvent. They've put an exceptionally qualified guy in charge of AIG, and Ed Liddy, who used to run Allstate. From that standpoint, I wouldn't be concerned. Where I would be very careful, and at this point, and it pains me to say this because I think it's a good company, I would not be writing structured settlements with AIG just at this moment. I'm talking really over the next week or two until
you need to take a wait and see on
just
that.
a wait and see. And again, I'm not saying that we don't write American General cases, that we're not going to write structured settlements with AIG. I just think that's foolish and counterproductive. But
you want more information right now. The picture is just not. It's a little
Right.
too confused here. We need more data. No reason to.
Right.
With all this kind of uncertainty out there, we really should wait now. There's a question mark that's been raised, and until we get a good answer to it, don't. Your advice is that you should just wait some time before
Right.
doing something like that, just in an extreme caution and making sure that no mistakes are made.
Yeah, and by contrast, if you have a case that's currently being funded with AIG, if you have a case in process, don't go to extreme lengths and try to get the money back and go through all that and cancel quotes. I think that would just be a terrible mistake. I think you would be doing your client a disservice. If you have a good case locked in, you've got a good price, these life companies are going to make their payments. You are going to see people lining up to buy these AIG assets. They're valuable companies. They're well run. They're well capitalized. Just as I was driving down here, the big rumor on the street is that there's a whole group of AIG stockholders who are going to try to raise capital separately in order to pay off the $85 billion loan beforehand so that the government doesn't end up owning 80% of AIG. They understand how valuable these companies are.
And that's because I think the point you're making there is that if the federal government, in fact, goes through with this deal and takes over 80% of the company, the requirement of that is going to be quite severe. That little Faustian bargain, because AIG is going to be forced to auction off its crown jewels. Is that right?
Right, exactly. So I think as we wrap this up, Jan, and we were kind of bumping up against our time limit here, is that, in summary, don't panic. It was a scary week. It was a dramatic week, a week people aren't going to forget. But the fact is AIG has the funds that they need. They're going to be managing this in an orderly fashion. Don't cancel out your cases that you have pending. Don't short sell your cases. Definitely don't go and cash in structures and try to cash in annuities. You'll be getting penalized. There's no reason for it. People just need to be calm, take a deep breath. These are fine companies. I think we've gotten past the crisis stage, and people need to be vigilant and careful, particularly professionals. But our picture is much brighter today than it was earlier this week. This is Mark Wahlstrom, and thank you for joining us today here on the Legal Broadcast Network.